Ladies and gentlemen, welcome back to Walk the Block. We are navigating digital finance all together. And like some of our good friends out there, they might also be in need of some of that walking the block money, if you will. Glad to have you guys all with us here tonight. By the way, Centurion, I also see you, brother. Thank you guys for showing up so much. You could say this might be a little bit of an American focused show because we want to make sure that everyone had a fantastic Thanksgiving holiday weekend. And it also includes Black Friday, which we have some data on that might be able to share some insights over to the overall economic portrait that we're trying to paint going on here in the United States. Outside of that, though, we also have more data. That's right. This is a bit of a data episode. We believe we might have identified the reason why there was a bit of a jump in the Bitcoin price, but also what's going on with the manufacturing world. Outside of that, we're going to be talking about that and so much more tonight. I'm your host, Zenith, and I'm joined by an excellent cast of characters, as always. Up first, we got Dace. How you doing, good sir?
I'm well, my friend. Not bad. Not bad. Glad to be here this evening.
Excellent. And we also have our third man, Tracker. How you doing?
Doing good. Just like everybody else, watching the, and I'll just be blunt, watching the manipulation in action. You know, just watching the market, seeing what we're going to do. Are we actually going to find the bottom and start going up? I know Dace has got some good info. He's going to tell everybody, and we've got a lot of information we're going to share here. So tell you what's going on, who are the market makers, and who's pushing, who's selling, who's buying. And hopefully it looks like we're trying to find a floor here in the December, and then what we think is going to happen in Q1. So looking to get into it.
Excellent. Makes a lot of sense. Tell you what, let's go ahead and start off with the headline story of the evening. That's going to be our second American holiday that happened after Thanksgiving, Black Friday, if you will. Because I remember a time when the deals were a lot better than they felt like they've been over the last few years. But let's see if the data says anything differently. Coming to us from CBS News, U.S. consumers spent a record $11.8 billion online during Black Friday sales. Looking at it here, this allegedly is a 9% jump up from last year, and overall slight increase from the company's spending estimate of 11.7. So there you go. You even beat the estimates. At least one thing is beating estimates this week. Outside of that, we get a lot of the other usual stuff. In-store traffic continues to dwindle, and online sales continue to keep rising. Does that surprise anybody at all?
To me, a little bit.
Really?
A little bit, yeah. Well, not online sales in particular, but sales performing like they did, right? When we look at the overall economic picture of things, it says inflation has gotten bad. The price at the grocery store has gotten kind of crazy. I know for myself, and so, but gas prices have also stayed controlled. But overall, I think people would say that cost of living has gone up pretty significantly over this year over last. And so for us to meet those overall projections, I think the foot traffic part is not surprising that it goes down, but the fact that the online sales kept up, to the total overall projection, that's a little surprising given just the nature of where economics are currently in the U.S. I don't know, maybe I'm alone in that. What do you guys think?
No, it's about, I agree with the inflation. Absolutely. You got to understand most things have gone up tremendously if you look at a percentage basis. So am I shocked by that? No. And I'm also would say most people are looking for those deals because they're so strapped. So most of your spending could be coming out on Black Friday, but Cyber Monday, obviously being today, is another big one. So you might have a huge concentration of spending if you're going to have a lot of spending on those two areas. The brick and mortar buildings and the foot traffic like we've had, decades ago, seem to be that's almost non-existent outside of certain things that people have to buy that they feel more comfortable. But yeah, I'm not surprised by this necessarily. I don't think it means that we're going to be that's a boom time for the overall spending on the holidays. I think it's going to be still a pretty bleak time. But it's funny how they compare everything to dollars. It's no different than just a simple comparisons, like looking at a movie. Oh, movies are breaking all time. This movie X broke all time highs. Well, yeah, of course it did, because it's so much more than what it was. Just as a side note, people don't understand. Yeah, like if you want to
Stupid.
if you want to compare it, I mean, and I'm not trying to be completely go off ends here, but yeah, you got movies that are breaking all-time budgets at the box office, but nothing will ever beat the ticket sales that Gone with the Wind had. I mean, if you really want to look at all-time sales, I mean, it's like I was something like 2/3 of the America watched that movie or some. So what I'm trying to get at is you can't compare dollar figures to what's happened in the past. It's always going to look like it's up and to the right.
You know, you are correct that we cannot compare dollars, but I do have one other comparison point I want to bring up here. So, same article. Despite spending more overall, Salesforce found that US shoppers purchased fewer items at checkout on Black Friday, down 2% from last year. Order volumes also slipped 1%, the firm noted. The average selling prices climbed 7%. So, dollars may be up, but technically, by the numbers, the number of goods shipped actually went down. Granted, it's 2%, so it's like that could be a statistical just error at that point. But at the same time, I think that is just it's a morbidly funny point to make.
No,
Well,
it is. It
it
is.
links into something I wanted to point out, which links together what Tracker said too, which is a lot of your online providers are going to have not have the overhead costs that stocking your stuff in a brick and mortar place has, and they're going to have shipping deals. They're going to be able to give you a bigger edge on these sales days, which is only going to add to the imbalance between the in-person and online sales as well, I'm sure.
That's for sure. But no, a Tracker, I think you hit it on the head there, which is like, yeah, dollars are up, but does that mean like sales are actually up? Think you're onto something.
And keep in mind, but look at your source. That's a mainstream media. Their job is to try to make sure the economy is looking great or in some shape or form. At least, and some are trying to make it look worse than others. So you got to take everything you read from a grain of salt. You know, is it biased? Is it unbiased? I mean, who owns CBS? I mean, you know what I mean? So you got to start going down that rabbit hole. So I'm not trying to go down this conspiracy theory on all this information. It's just you got to know what the information is. But I think that's the easiest way to look at it. Don't necessarily look at the dollar figures. Look at what other metrics they can use where they're comparing, you know, how many clothing items are being purchased versus, you know, the last few years, or how much cosmetics or how much electronics are being spent. Keep in mind, electronics obviously have gotten cheaper over the years. So that one's a little bit, but we've covered this in the past. I'm not going down that rabbit hole, but you know what I'm saying? We have to compare it. It's just, you can't go off the numbers. That's all I'm saying.
That's true. Look, electronics are getting cheaper. Certain computing components, some of us may have paid an arm and a leg to acquire this year. But overall, I will say, I think we saw that TVs, computer monitors, those kinds of electronic goods, they did see price decreases. As far as other computing goods, such as RAM, memory, GPUs, core functions, those have kind of gone up a lot this year thanks to AI, but that's neither here nor there. I will say there is another little tidbit to this story I do want to run past you, gentlemen, which is that if we flip down here, we see final line of the article. At the same time, credit card debt and delinquencies on short term loans have been rising, and more shoppers are turning to buy now, pay later plans, which allows them to delay payments on holiday decor, gifts, and other items. Gentlemen, when they say buy now, pay later plans, what kind of services is that in reference to?
I just got to be I'm going to be a smart ass here. I'm sorry. It's basically the American way. Take on more debt and worry about the problem later. This is an issue that's plaguing most of United States and I'd say other countries as well. The debt, you're just taking on more and more debt. When I always think of that, I always think of Rent-A-Center. That's what I always like to think of,
The
but
classic.
that's, a rent to own or any of that, or the old school layaway, right? You'd lay away, you put it on layaway and try to, afford it over time. But you never got you didn't get the actual, you had to pay it off before you could actually get it. So, I mean, once again, you got people strapped, and the numbers are coming out more and more. The debt is at all time highs with how many people are in debt. Credit cards are racking up. People are not, and you add in the AI, you add in all the cuts that are coming through, and it's Main Street is really suffering. Wall Street, not so much, and that's unfortunate, but that's just how it is. And so I think that trend you're going to see keep going. It's going to keep happening. Maybe this is the reason why I know the administration is trying to give a $2,000, you know,
Yeah,
helicopter money to folks to try to help them out and dire times. Whether that gets passed or not, who knows? But it's just inflation and everything else is just that is absolutely just killing people on the low end and the poor. The people on the low end that are on the low end of income are really struggling, are tremendously struggling. Middle class is turning more into the low income. The gaps between the upper class and the middle class and everybody else is separating dramatically. I don't think that trend's going to change anytime soon unless something seriously dramatic happens.
Yeah, the old K-shaped economy. I hear you. I think that your point of financing and debt are the American way. I mean, it's kind of a reference back to like kind of the scene from When the Grinch Stole Christmas, the live action one. They have the scene where they're celebrating, "Oh, I'm going into debt for 6 months to pay for all these Christmas gifts." Sure, but I think there's an additional wrinkle that might actually change things this time around. I'm not saying immediately. I'm saying maybe in a year or two, I could see we actually have legitimate effects that happen. Coming to us from Business Insider, Black Friday shoppers are now relying on buy now, pay later plans. Here's how that could backfire. Let's see what we got. In its 2025 holiday shopping trends report, Adobe expects Americans to spend almost $12 billion on Black Friday purchases, which we saw in the data, surpassing last year's total by $1 billion. Okay. While some shoppers are buying things outright, many are relying on the buy now, pay later plans, which allow them to spread payments over time. Between November 1st and December 31st, Adobe estimates American shoppers will spend $20 billion online through these plans, an increase by 11% from 2024. Okay, well, I guess that kind of makes sense because we've seen these things come out, a lot more businesses, a lot more options, a lot of people doing the whole, yeah, I can pay my Domino's pizza off in a 4-week payment just for the laugh of it. But at the same time, I gotta find it here. Here we go. In June, FICO announced plans to integrate this data from the buy now, pay later plans into its credit score beginning this fall. Well, last time I checked, fall is pretty much just ending. We got, what, 2 more weeks on it? So these scores provide lenders with greater visibility into consumers' repayment behaviors, enabling a more comprehensive view of their credit readiness, which ultimately improves the lending experience. Well, I mean, how bad can it be? We've been doing this whole credit card thing for a while. Well, this one gets a little trickier. In November, Lending Tree report found that 41% of buy now, pay later users reported making late payments in the previous year. Quote, surprisingly, high income borrowers are among the most likely to pay late, along with men, young people, and the parents of young kids. I would say that's quite a wide sweeping demographic there. But this is my point, which is that are we seeing the rise of buy now, pay later? Yes. But I think there's the actual introduction of potentially a pain point. Theoretically, hear me out. If it actually becomes an issue that affects people's ability to purchase things later on, or almost maybe even more immediately, if people say, I don't know, start getting denied for these things, that could be the thing that triggers the response of changing behavior and perhaps not using these payment plans. Does that make sense? Or is this too wishful thinking, do you think?
Well, I I love the sentiment, but let me provide the devil's advocate position, which is people already
Please
feel
do.
like they can't buy a house. People already feel like they can't afford it, which is why they're financing their Pizza Hut, right? And so it's a tough spot, man. I think yes, the repercussions and implications that are going to come from people taking care of their credit will be surveillance overreach. Like until you hit people in their behaviors, they're not going to change, right? And so another thing that I would say is we've talked about a lot on this show, um, the U.S. policy towards its own debt, and like as the country goes, so does its people, and so is it any wonder why the people in the nation with the astronomical amount of debt has astronomical amount of debt? It's an echo through the whole culture.
I think the
It
more
is.
irony is how is it that these score companies that are controlled by the banks could tell anybody that they're doing bad with debt when the banks are absolutely drunk on debt? I mean, the irony is just it's it's
It is
comical. It
dripping.
really is.
Yeah. I I think you could try to make the argument that maybe if you're more in the TradFi banking sector, the loans that you're making have a higher probability of having repayments on time and less default, and then also collateral, because I don't know what you put up for collateral against your DoorDash order, like a shoe. What do you put up against that?
I don't know, but I think the fact that it's the scary part of the fact is that's trending or it's starting to get that route. That's what's crazy. So
The collateral is that the delivery guy knows your address. That's the collateral.
I don't know. You start eating half your order every time you buy something. Yeah.
That's it. Yeah,
Well,
man.
Well, yeah, here's a question for you. Okay, so we've been focusing on overall economic data. This year, we've seen the shift from inflation focus to jobs focus. We've also seen the absolute evaporation of all the savings that started happening during 2020, 21, 22 a little bit. And now we're seeing not mass layoffs. We have seen an increase in layoffs a little bit this year, but just honestly, not many jobs being added. So combine that outlook that we've previously talked about a lot on this channel with the new data that we're getting now, which is like this kind of seems like business as usual when it comes to Black Friday stuff. How do we balance these two things out to get to kind of what is the holistic picture for how people feel in the United States right now? Does this change that data? Does it just seem like doom spending? How do you guys try to read this?
Oh, I mean, I think it's what again, just to circle back on a super zoomed out level, it's what our culture cares about. It's there's a dissociative effect, right? Retail therapy, I think, is a term that gets thrown around from time to time. I think with good reason, put it that way.
Yeah.
I mean, I just think we're at the point where Main Street and Wall Street, they're completely decoupled from one another as far as how they have the viewpoints. People on Main Street are really struggling. I think you're going to keep seeing that. How can you not? I mean, salaries are not increasing anywhere at the rate to keep up with just inflation. They tell you, they tell you 3%. Oh, come on, we know it's more like 9% over the last few years. It's been at 9%. Traditionally, it's around 7. You can even argue it's been higher than that. At some points, I mean, you could even look back in some things that were going at 15, 16%. So if things are to keep getting more expensive and yet no one's salaries are going up, it just is going to keep strangleholding the people living on Main Street. So I don't care how you want to twist this or bend it or how you want to say it. It's going to keep coming down to the consumers, and the consumers are going to keep getting hit. Eventually, you're just not going to have enough consumers. You're just not. And that's the thing that they're looking at. So I don't know what they're going to do about the runaway inflation. And I don't see it. But obviously, we've talked about the solutions. I know we talked about it before, how the China, and I know I'm trying to go off topic just a little bit here, but I'll tie it back. Good. China's out there now banning Bitcoin ownership again. They're out there starting to say it's now you can't own it again because it kind of feeds into the narrative that they want the digital yen that be backed by their Volt Gold program that they're working with the BRICS. So they're leaning more towards that program and against any other cryptocurrencies, really is how they're looking at it, while the United States is going heavy stable coins because they're looking at refinancing in the U.S. debt with U.S. treasuries being bought by stable coins. So you have two different sides of how they're trying to battle this out. I think you're going to keep, those are going to be potentially the solutions. I know we're moving towards some type of reset. I understand when he's talking about 2030 reset, and I get all that. If you guys don't know what I'm talking about, go out and look Time Magazine, look anywhere online, 2030 reset. It's a big piece. It's not like something that's just being talked about. It's already been in motion. But eventually the digital system is going to get a revamp. We're all been talking for quite a while here that digital assets are going to move to the Ethereum network because it's the largest, most stable network where they can start stabilizing this. And then somehow there's going to be somewhat of a reset. Now, what does that look like? Are we going to move to more digital assets, tokenization? And is that going to allow then all of a sudden your paper money is going to just go away? No, I wouldn't say that, but it's going to be more of a shift. Now, how does that shift? Is that going to help us? Are they somehow going to twist this up to where that's going to really get inflation under control? Are they going to change it somehow? So something's going to give, because it can't keep going the direction we're going.
So we posted in the group.
I don't know what it's going to be.
In the Walk the Block Telegram, we've posted that New York is already running a USDC stablecoin experiment where they're dispersing, what is it, $12,000?
$20,000. It's $20,000 of people. The one I read, all right, maybe it's 12 then, the one you saw, but I remember 20. But I remember we talked about this like 6 months ago. The United States was going to give out. Well, go ahead and finish the story.
No, this is what happened this past week. Yeah, this happened just this past week. But anyway, yeah, I mean, To zoom back out, that's one way to address the issue, right? If you squeeze out all the middle class participants, you have to do UBI and just drop people money to keep the game going.
Right. No, they announced it. So they announced it quite a while ago, beginning of the year, some point like that, and then they just launched the program this week. If you're talking about in New York, where they randomly selected a certain number of people in New York, and they're giving them, we'll say $12,000 in Bitcoin or crypto in general. I don't know, was it all in Bitcoin or just in crypto in general, but to see how they spend it, how they use it within the economy. So I mean, I would like to have been part of that program, but I mean, I wouldn't have spent it.
Just shut your link.
Thank you, sir.
Yes, sir.
And
but yeah, I think that's something that will come up. You know, it came up briefly in the 2020 election, right? We had a third party candidate who was really interested in pushing that on his card, and I think it will come up more into the future, particularly from the left, right? In the last administration, the Biden administration, we talked a lot about its stance towards crypto, and how it was a bit of a legislation through enforcement, you know, not really necessarily very friendly. I think stablecoin, universal basic income will be a platform in the future for the left to sort of embrace crypto moving forward. Just something to think about in terms of it fits their platform goals, right?
Yep. And there it is, universal basic income, which is the big boogeyman everyone sees coming. So
hear me out. This is actually something I've been wrestling with for a while, which is that by the data, universal basic income experiments typically all fail, especially because it just destroys and corrodes the aspiration for self-reliance, and it destroys so many of the communities that it's tried in, especially the ones that are like repeat, long-term, that kind of stuff. Stimulus checks can be like a temporary relief but it's not like behavior altering versus UBI is. The thing I'm wrestling with,
it's non-sustainable.
Correct. The thing that I wrestle with is that, like, looking into the AI future, don't want to go down that rabbit hole too far, but like theoretically, if AI is going to do all the things it says it's going to do in like 10, 12, 15 years time, that is such a fundamental shift where I genuinely don't know how UBI is not the answer for that, because you're talking about supplanting humans from the human economy. You're creating an economy for robots, and then if there's no people in the economy to get salaries to buy things that they need, then that whole thing kind of just fails. And it's like, well, which one do you want to continue? We either get rid of AI effectively and kind of like force people to go back to the less advanced ways of doing things, or you supplement the existing economy, that is the AI economy. So like I think that UBI is unfortunately a little bit more of a complex topic than we would like to believe, but as it stands right now, the data shows that UBI is not good from the human element anyways.
Well, it's horrible. And then the funny part is, all right, let's just say that this does all come to fruition, or say AI and everything, like 40%, oh hell, even 30% of the workforce is unemployed, right? Which that would put us to the Great Depression numbers, by the way, like 30% of unemployment, 40%, somewhere around that ballpark. Let's say we go to that. Who's going to buy all the stuff that they're making? Like, who's buying it? Like, you're making what now? So the corporations are like,
they're going to hand it out.
But you guess what I'm saying? Like, what's the point of so you've thrown out the whole idea of even having a company anymore. You know what I mean? Like, the whole point is to be profitable making a company. Well, if you stranglehold all your consumers, you know, no one's buying your stuff. So what? And we can go down this, like you said, you can go way down this rabbit hole much further in a more degenerate manner. But I know I don't want to get too deep. But
this links back to the house conversation. You're talking about people protecting their credit. You know, people won't buy stuff. They're gonna rent stuff. They're gonna put it on this buy. You know, get it now, pay for it later. That they're gonna do that for, you know, all scales of your purchases through your life, you know.
Well, yeah, the whole thing, right, Dave? So you'll own nothing and be happy, basically.
Bingo. That's it.
Jace, the answer you proposed for your devil's advocate argument at the beginning there kind of ultimately was going to be my answer to the question that I posed to you guys, which is like looking at the Black Friday data, looking at the economic sentiment data before all this, how do these two things merge together? And as sad as it is to say, I think that you hit it square on the head there, which is that like, can you try to impose penalties via credit score for people that are not paying back the short-term repayment plans? Yeah, but that only matters if they care about the credit score, which is used for big purchases like fancy cars and houses. And I think it's, believe me, it pains me to say this, but I do believe that the sentiment that a lot of people are just writing that off as just not within their lifetime, which is crazy to say. But I think that that sentiment is going, and that is an excellent explanation to the question of we have what appears to be very, very bad economic sentiment. Data numbers are different because I think it talks about different parts of the economy, but combining that with still spending more on Black Friday, still seeing increases year on year, I think it does point to that doom spending or just not caring about long-term spending and instead kind of just like trying to make it to next month, so to speak.
Absolutely. Absolutely. You know, they, when the stimulus checks went out, they didn't claim to be connected to any coinciding health related event that may or may not have occurred at the same time. It was just, this is a stimulus for the economy, right? Um, how often can you hit that button before it becomes universal basic income? You know, and I think we're going to find out.
I mean, for me to play devil's advocate on that one now, well, I would argue that the reason or the legitimate reason for the stimulus checks during that time period was that the government told people to shut down businesses. It actually imposed on the populace in ways that they should be compensated for. Gosh, gonna make myself a fool here. I want to say it's Fourth Amendment, which is that you cannot be deprived of property without just and compensation. So that kind of attitude, whether or not it actually turned out that way, the answer is kind of no. But that was the constitutional justification, anyways. But that's very highfalutin stuff that we really don't care too much about.
No, it's actually very sound, and it links back to what Tracker said as well. Of like, you know, there's, I guess, what's the best way to say this? There's not going to be any sort of like, well, what you said. There's if you apply supply and demand principles and you take one side and you make it infinite, how do you account for it on the other? You know, the humans are just variables in between and in between the problem. You know, if AI scales like we're talking about it scaling, and so yes, the government asked people to shut down, and so that was the governmental justification. But if we have, in effect, the same loss of work and the same loss of economic energy output from humans because of the development of AI, right? If we go back to the Great Depression era that Tracker was talking about through this technology, you know, that's going to be that will be their justification as well, I would think. You know, if they can excuse it with what they excused it with last time, surely, you know, when robots are walking around, they'll be able to pass the buck in that moment too. Who knows?
I think the end state looks very similar from both situations, but I think the reason that you can justify the COVID stimulus checks was the source of the action, which was the federal government, and that is a very different force than the market evolving, unfortunately.
It is, but there, you know, one is responsible for the other, right? And the outcomes are gonna bleed, you know, through from one to the other, I would think.
Hear me out. The practical answer for the three of us is that do we believe that the government is somewhat responsible for the way that the economy runs, especially considering how deeply tied to the economy it is today? Yes. The legal answer is going to be no, though, because the government does not explicitly run the government, or I mean, the government does not explicitly run the markets, and they have no direct tie to the market outside of like government contracts, procurements, payment of government employees, that kind of stuff. So
Sure.
I know I'm getting in the weeds on this one, so I'll leave it be.
No, you're right. You're pointing at their legal justification, and you're not wrong. But like, I just wonder if the dynamics in force and in effect will follow those same rules. We'll see.
And just for you to add to the you know the renting concept, 84-month loans or 84 plus month loans for cars have also hit an all-time high at 20%. So all new car financing at 20% of all new cars have been 84 months or longer has been the trend. So that's
Is that
growing.
7 years?
7 years, yeah, 7 years, but there's plus. At 85 months plus, they have 17%. So you're seeing people pushing even car loans out further and further. Now that could come down to people wanting to buy cars they just simply can't afford if they want to have it. But you're paying all that debt, so you're seeing a trend where people are willing to just get now and worry about it later. On a side note, there was a great documentary on the invention of the credit card. I advise everybody go watch that. That was fascinating, which was an experiment in the 40s, so right during the baby boomer generations when they started coming out with credit cards. So credit cards have not been around that long. So it's a boogeyman. It is.
I'll tell you what,
form of enslavement, basically.
If there's a book on that one, I'll suggest it for book club, and we can torture Will for one more week.
There you go. But the big thing, just to sum it up here, so if you look at Main Street, it's suffering. Wall Street, they're looking for rate cuts. They're looking to have more cheaper money to finance and really take off to the next leg, which we're trying to. That's really what we're going to be talking about. But the big caveat here with the whole universe-based income and all of these subsidies, and where basically you don't have to work to earn your money. There's a big underlying psychological problem there with that model. You start as a human, you start looking at what's my net worth, like what's my worth is the big question then, right? So great, I get money, I get to, what do I do with my life? And I think that starts to weigh heavy on, that's where depression kicks in. That's where you don't feel necessarily motivated or how you should be. It's toxic. Like people need some worth. I know people can go out there and do other things, be motivated, do other things, but I think a lot of people do identify by their job or what they love to do and things like that. So if you take that away, that's going to be a ripple effect. So I don't know. It's a whole psychological aspect of it too.
There really is.
It's not sustainable. But
true. By the way, I do have you're speaking about the Main Street and the Wall Street. We do have a little bit more data I do want to bring up here. So we did get some new data this month talking about the manufacturing PMI. So breaking PMI came in at 48.2. It was projected to be at 49.0. By the way, the previous month was 48.7. So bit of a split on that one. They were expecting it to be better, but it turned out to be a little bit worse. New orders went down. Employment went down. Prices paid went up. Previously 58, 58.5. Okay. Let's see if there's more to this than just
prices paid. Prices paid brought to you by inflation.
There you go. Yes, sir. Alrighty. Again, headline number is 48.2. There you go. You get your nice little table as well. This covers a little bit more. So where did we see increase? Well, we did actually see an increase in production. We saw increase in inventories, customer inventories, slight increase as well. Prices up though. New export orders up. Imports also up. I think that you could argue the imports increase there is partly due to the fact that we've had a lot of tariff negotiations earlier on in the year that slowed imports, and now they're catching back up to it. So that's what we're seeing. Let's see what they say. Overall economy, growing, rate of change, slower. Manufacturing sector, contracting, rate of change, faster. I know I have this very small. Let's see if I can make it bigger for you. How's that? Is that concerning at all?
Well, it's concerning for us because we want PMI to go up into the 50s.
That's true.
From an investor standpoint.
There you go. The bottom line. Let's give the TLDR of why we care about this one in the first place. What are we looking for?
What, for PMI?
Yeah. Why do we care about PMI?
Well, it tells you basically how much the manufacturing is going. It's a very good indicator. It tells you in the economy. Days has been all over this one. Others have been on top of this one too. But basically, when PMI is hitting into the 50 handle, as it goes higher, that means there's more production, there's more spending, the economy is booming. There's more consumers consuming what's being produced and getting consumed. It's something that everybody looks at, and infamously for that, if PMI is going up higher, then more people will really take on riskier assets. Plus, that collides into the crypto. People are more willing to take on more riskier assets, and like I said, crypto is definitely in part of that. So PMI is a huge indicator, and if you notice, we've been in this sideways for a long time. We've been below the 50 mark. I mean, we've had a little blip. I get it, but we've been pretty much suppressed for a very long time. to show that the strength of the economy. So PMI is the big one that we all are watching because we're waiting for it to find. When is it going to finally go up? And typically, I know we looked at this a few weeks ago, but when rate cuts start to kick in, it does take a little bit of time for that to trickle down into the PMI. I think when we looked at it, it was like 5 months it takes to finally really start working its way down, because when you do rate cuts, the rates don't just immediately just start picking the economy up, or the lending gets cheaper. But I'm gonna put the risk aside. I'll come back to that. But when the rates come in, you have to. It takes a while for those rates. The big guys, the big banks, central banks, they're the ones that get the lending early. Then they take that and they lend that money out, and it gets lower, and it works its way down, trickling down into the economy. This is very simplistic what I'm saying here, but it is working its way through the system, almost like oil into an engine that's been seized up. And as it goes down, then it starts to move things quicker through the economy. Now, the big dilemma here is that some economists are really on the fence about our if the economy is doing really bad, then it's riskier to lend more money. So a good way to look at it, say you had $100 million on your books, and you're saying, okay, hey, I got $100 million, and I can lend it out to people to get those loans out so we can make money. But if the risk is too high currently, it was because of the poor economy, then why would I lend that out? Why am I going to take on the more risk? But then if they start cutting rates and say, hey, I got $100 million. Here's $300 million. Is that going to help your problem? Well, no, it's not going to help my problem, because I still got the risk problem of the economy. This is where a lot of economists, people are really split down the middle on, and that's really is the line why you have the bears and you have the bulls, because bulls are saying, well, the rate cuts are coming. That should allow to trickle down into the economy. So you have to get more aggressive, because you have a lot of refinancing of debt, and typically small cap companies are the big winners there because they have such a low margin and they always their debt. So they're the ones that really reap the reward on lower rates, much more than a larger cap company. So that's where you'll see that. And thus those are riskier assets. That's why you get these rate cuts and it goes into small caps. That's why they tend to take off. But if the economy is really poor, are they actually going to be lending down and giving lower rates to people and letting them refinance if there's more risk there? So to be determined. And that's really why we're kind of, even if they get aggressive with the rates. Now they start doing quantitative easing. Now you're really talking about money really being pumped into the system, or the inflation of cheaper money. So then that could really start moving things temporarily, because it takes a while for that quantitative easing to get into flip over to inflation. So you get basically all this free money up front to really get things going. It really helps a lot, but long term it adds that inflation. I know it was kind of long-winded, but that's essentially all of it in a nutshell.
No, makes sense. I mean, PMI is similar to the Russell 2000. They track similar things, but the overall sentiment that we're looking for out of them is that we just want to see smaller cap stuff doing well. It goes back to the whole Black Friday story, which is that, like, is spending up? Yeah. Does that mean people are doing better off on the bottom of the K-shaped economy, if you will? No, it's been bottom half's doing worse, top half's doing better. That's what we're looking at in the markets overall as well, which is that, yeah, sure, Nvidia and the rest of the fabulous 7 or whatever you want to call them are doing fantastic by the numbers, but it doesn't mean the rest of it is. And if that's the case, then it means that the overall environment is that people are trying to go for the less risky things, which is why you're seeing a lot of it get swallowed up by the top performing companies out there. And that overall says to the markets that it's kind of a risk off environment. Not entirely like downturn per se, but definitely risk off. Tell you what, speaking of markets, we might as well take a quick peek at those, because we did actually have some movement recently. So the old Bitcoin chart, what are we looking at? Well, here's our weekly chart. See that green candle there? That was the sliver of hope that we had. We got all the way back up to about $93,000 before we broke down back down to around 84,000, where we currently sit. All right, let's zoom in a little bit. What do we have? One big red candle for yesterday, after we did go up and really test this 20-day moving average, by the way. But let's break it down even further. Is that a gradual down, or is that a very one quick down? That looks like a big one quick down for me, because, yeah, that came over the course. We went from 91K to pretty much 86K in the course of 2 hours Sunday night, right as we went live over at TGen Roundtable, by the way. So that was fun to think about, but we had cooler stuff to talk about, so we didn't really mention it there. But overall,
well, just to say on there, I know Dace, you listed out the players that were dumping, which central exchanges were basically dumping, but I thought we basically came away with the idea that It seemed like a timed dump because it happened right on December 1st. So these might be just executed sells that they had already in motion. That might be a timed that triggered it.
You are not the only one that believes that to be the case. This is one of the popular narratives that I was seeing over on crypto Twitter. Is that the exact reason why the market crashed? Take this with a big grain of salt, by the way, but it's an interesting idea. Wintermute dumped. This is not dollars, by the way. This is Bitcoin. 9,000 Bitcoin. Coinbase dumped 8,000 Bitcoin. BitMEX 7,900. Binance 5,400. Bitwise 5,000. Bitfinex 3,700. That is a good chunk of change, all dumped in a 24-hour period. And yes, it does coincide with the time frame.
Yeah, so to me, that's enough to shake people out, and that goes into a bunch of other narratives that we were covering last week, Zan, from all the different, narratives all the different narratives that are going around out there. This will fall under, some of the larger whales or central exchanges that are just unwinding some of their long-term holdings to profit because now there's more liquidity in the markets, and then it ties into less slippage for them to unload these large amounts of dumps, but. But Dace, even though we got dumpers here, Dace, who's the big buyer or the big 800-pound gorilla coming onto the market?
Well, so a couple of things. They just announced today that Vanguard will finally be announcing ETF products. So that's a big deal. Vanguard's a big player. They've been working on. They've been very slow to adopt. They actually very famously decried the crypto ETFs when they were first launched. I saw a meme post about one of their old posts talking about how bad they are, and now here they are joining the party. And so that's one big player that's joining in. I also saw just now that Michael Saylor of Strategy fame raised something like a tremendous amount of money again somehow, and just recently bought, like within the past hour or so, that's dropped. And so yeah, there are certainly big institutional players scooping up these big dips.
And just for everybody's knowledge out there, Vanguard, there's one of the big three out there. So Vanguard, BlackRock, State Street. They, in all intents and purposes, in one way or another, they almost own each other, or they own most of the entire markets. So they pretty much control close to 80 to 85% of the entire markets. And people are like, they'll say that's nuts. No, it's not true. Well, it is. Deep digger, you'll find it out. So the fact that Vanguard now is getting involved.
The number that I saw is 11 trillion assets under management just for Vanguard, right? According to however they're measuring it. And so just that, $11 trillion assets under management is bigger than the entire market cap of crypto a few times over, which is wild.
Yeah, take 5%. Just say just 5%. Just 5%. If they just move 5% of that, is enough to absolutely move the markets. I just think it's interesting how a big player like them, like BlackRock was one of the first ones. I don't know, is State Street involved yet? Because BlackRock's been around for a while with Larry Fink. I know that they've been there. They've been.
I know Fidelity is.
Oh yeah, Fidelity's been one of the very early, but they're not one of the big three. Fidelity is they were way ahead of everybody. They were buying Bitcoin back in like 2013. Like they were one of the first buyers of Bitcoin, a big thing. I mean, they're out there buying it with the real smart money.
That's true. Look, it's yet again another thing showing that price is going down, but people are taking advantage of it for sure. I will say it is kind of funny though, because I'm pretty sure, gosh, we talked about this back in 2024. Probably it was around the time of the Ethereum ETF launch, I want to say. There was somebody from Vanguard that actually came out and publicly said, yeah, we will not be getting into this because we just don't think it's worth it. And then after that, we watched both of those ETFs continue to be some of the most profitable financial products ever created. And then we also saw the creation of more ETFs this year as well. So I think our original prediction was that somebody's going to get fired for that mistake, but I'm still waiting for that announcement. But as it stands right now, yep, they're getting in the game, baby.
So BlackRock obviously has been involved. Vanguard's getting in. State Street is currently does not own any crypto. They have no Bitcoin or Ethereum or any digital assets on their balance sheets currently as of December 1st. So, which is today. So there you go.
That's fair. By the way, Centurion 54 coming in here. He says, I remember a year or two ago, DCC Miguel calling for a top when Vanguard came into the crypto market. Well, I mean, The guys had some really good insights. I don't know if all of them are 100%. I think the fundamentals may have changed a little bit on this one, but if that's the case, man, that's could be an indicator. Vanguard's behind the ball, and this time they're marking the top. But at the same time, though, I think that even to bring it back to the price action on the chart, does this break down anything that we have not already been talking about? No. I see that the conditions on the ground are still very much the same. We are seeing low liquidity and then large players dumping into that, which low liquidity drives prices further. So it's not super surprising, but at the same time, it is not the potential reversal we were hoping for. There is a pretty good bounce that came off of it. I mean, going all the way back up to 93K is pretty darn good. Granted, it does not get us back above that 50-week moving average. So for the people that are still pinning their hat on that one, they are still technically correct as it stands right now until history either proves or disproves their theory. But overall, I think what we're seeing is that the fears of the drop that just would continue to go all the way down to like 70K, 50K, 40K, that did not happen. Was this the perfect V-shaped recovery that people were looking for? The answer is also no. So we're early on in the week. We got to see what happens here. But as it stands, like the fundamentals have not changed. So it's going to kind of be up to people to buy up the lows and make the moves as they see accordingly. And then also we're going to have to see what happens with the markets. Yes, there was about $600 million in liquidations on last night, if you will. But outside of that, I'm standing by it. I think the fundamentals have not changed. This is just price movement.
I will say this now. There's, for TradFi, right now it's December. They are in most of the traditional markets, so they've all done very well over this last year. This whole year, they've done pretty well. There's no need to step in and be a hero right now and try to pick a bottom or try to do anything right now. If anything, they may start trimming some of their positions just to get, lock in some profits, tax purposes, and trying to restructure, not really their portfolio, but just taking something off. So if you see more selling right now in December, it's not necessarily that it's going to be a bad thing. It's just that you got to understand the thing that's more concerning that I have is the fact that Ethereum, altcoins, and outside of Bitcoin and a few other cryptos they've done pretty okay for this whole year or even last year, but crypto has not done anything with keeping up with traditional markets. Traditional markets are all-time highs, or they're flirting with all-time highs. I know they're kind of jumping around a little bit. Gold's at all-time highs. Everything's at all-time highs. So TradFi has done very well. So don't expect a lot of stuff to happen in December. If anything, we're probably going to go maybe slightly down to sideways. And then you're going to have to look at see what happens in Q1, January and February. That's going to be more when the things start to move, because the fact that that's when asset managers start to lay out their portfolios and their decisions, what they're going to lay out, how they're going to do this. So, and it's going to come down to the economy. We know that rate cuts are coming, but we don't know if that's going to be enough to really trigger the economy to really get it going. And that goes back to the ISM number we were talking about. Is that really going to get it going? Now, this administration obviously is going to has already pretty much leaning toward a new chair. I don't know if he's come out and made it official, but he's already picked who the chair is going to be. They just haven't come out and made it official. But once they come out with that and they get very aggressive, then that might be enough to start, helping 2026 become a stronger blow off top year, maybe is how you want to look at it. But until we see some of the seriously aggressive natures or more dovish talks from the new Fed, I think we're going to be kind of in the sideways action to down, unfortunately. Now, not to say that something can't turn it around and make it bounce back. I mean, I'm still holding my positions. I haven't taken anything. I'm sitting tight, but I just don't expect a whole lot to be happening in December is where I'm really trying to get at, because the big market makers, and we're hostage to TradFi now. I mean, we are. I don't care what anybody wants to say. Yes, there's big whales out there that are owning still, and there's central exchanges. When I say TradFi, I do include central exchanges in that, because I feel they are basically now TradFi, unfortunately. So that's kind of where we are. And so I wouldn't expect anybody who's had a good year to really get aggressive right here, right now. Now, the fact that Vanguard's coming out and saying what they're saying, I mean, it's a very interesting take that they just came out and stated. I don't know when they're going to start buying it. I don't know if it came out when they were going to start aggressively buying, but that might be setting up for January. Who knows? But
Hear me out.
Yeah, go ahead.
How long ago do you think they made that decision?
Oh, I think it's been in the cards for quite some time.
Months. They publicly said it's been months they've been working on it. No
There
doubt.
you go. So maybe the announcement is just based on the price performance at the current time, which it is rather suppressed right now. And a lot of the indicators, especially fear and greed sentiment, I think it's sitting at like 21, 24 right now. We got all the way up to 29 when we had the recovery up to 93K there. So just to show you, even at the top of that recovery, it was still that low. So it could be timing, could be game theory, could be just they do things on their own schedule. Who knows? But look, it's the timing is something to question for sure. And Tracker, by the way, I did have this I wanted to share with you. You've been asking this question for a hot minute: is who will be the next Fed chair? Well, according to Polymarket, Kevin Hassett, which, by the way, he is the director of the National Economic Council of the United States.
Yeah.
And he's been doing some media pieces lately. So Polymarket has decided that, well, that's the betting favorite, all the way up to 79%.
Yeah, and I saw Sami say something. Which shout out to Sami. That was really funny. The fact that Hassett has the word asset in his last name. I mean, that's classic. I mean, that's pretty good. Pretty good.
Tell you what, we do have one final note I do want to bring up. This is coming
Zenith,
from
I do want to throw out here. For the last 3 weeks, your largest buyers have been MicroStrategy, BitMine, Paramount Holdings, spot ETFs through Fidelity and BlackRock, Multicoin Capital. Arthur Hayes has been buying $260,000. He's been buying. Even the Arthur Hayes throws out a lot of mixed signals, man. He throws out a lot of mixed signals. So take that for a grain of salt. Marathon Digital. So those are your big buyers who've been buying it. So those seem like the big guys that control a lot of stuff. So the fact that they're buying, I mean, tells me that eventually there's going to be enough buyers in here where there's going to be a floor put in. And now, is that floor at 74? Is that floor at 60 for Bitcoin? Who knows? But the floors are getting put in. Are we ever going to get back to 13,000 Bitcoin or under 20,000? I don't think those days are gone. I think 30,000 is gone. I think 40,000 is gone.
What's the name of the variable? It's called like the Bitcoin power generation cost. There's a floor linked to that, and it's at 71K currently, and so that's something to keep in mind for reference. I'll see if I can find it.
So is that the cost? So you're referring to right here. This is the cost that it takes to mine a Bitcoin, correct? Yeah, the electrical cost.
So. Yep.
Right. So, I mean, there
the
are places like El Salvador out there that use geothermal.
That's true. Is this a decent metric to pull up? Yes, for sure. But if you dig into define electrical cost. Okay, electrical cost where? For who? With what? Those are kind of the questions you have to answer. So I take this number as an aggregate of the average. I don't take it as the lowest possible cost, but it does point out something very interesting, which is that Bitcoin really doesn't go below the cost it takes to produce a Bitcoin. Imagine that. Something not being worth less than one of itself. That kind of makes sense to me. Granted, there are times when we flirt with it and we kiss it and we dip below it for a wick or two, but it's never sustained periods below this level. So as it stands currently, 71,000 is the electrical cost. It can fluctuate, but overall it does track price and kind of go up and to the right because, well, cost of energy is always kind of going up and to the right. So
that's crazy though. Look. I mean, based on the cost that it takes, look how expensive it's gotten. That's crazy. I mean, if that's accurate,
correlation is astounding.
Yeah, that's
that's the wild part about the chart is like, regardless, I'm all for picking apart how they define, right? Like, let's be specific about terms. What does it mean by energy costs? But kind of doesn't matter if they can draw the line that it's never gone under.
Floor. Yeah,
that's a big deal.
Yeah, it's a floor. It's a floor, certainly. Yeah, it's a nice find, Ace. Nice find. But I guess what I'm saying, it's crazy because you just go back to 2022 and you're telling me it was what? The chart, it doesn't really show 10,000. Yeah, I mean, and in 2021, sure, yeah, it's gone up. It's gone up dramatically in the cost. Now, I'm just curious what variables are coming into that. Is that because of the cost with the infrastructure, because of AI gobbling up stuff? I don't know. It's a huge jump. I'm just curious what goes behind that. I'm gonna look at that real quick.
Difficulty is also a key factor here. which is that this is not tracking electricity costs. This is tracking the cost to make 1 Bitcoin. Bitcoin is the factor of hash rate and difficulty to mine a Bitcoin. As there are more people that enter the system, the difficulty goes up. Therefore, it requires more computing power. Therefore, it requires more electricity. So it's not just electrical costs. A large chunk of this is difficulty as well. Theoretically, difficulty can go down as people exit the market, but at the same time, the level of technology and computing power is only going up as we move into the future. Gosh, what's the name of the law which states like computing power doubles like every 18 months or something?
Is that Moore's law? Is that Moore's law?
I think so. Yeah. So you got to take that into consideration because remember back in the day, you could mine Bitcoin just on a computer, not a fancy computer, just a computer with a CPU. Eventually, we moved into GPUs as we had more processing power there. And then eventually we went into the world of ASICs. And now ASICs are even getting more advanced on top of themselves. And people are stacking them deep to get even more processing power out of it. So it's a factor of all these things. Can the difficulty go down? Yes. Do I think it's going to go down by a factor of like 50%? Not personally. So hear me out. I was looking at the numbers on this one. I think that if you wanted to say 40K Bitcoin for the bear market low next cycle, I think that is a reasonable estimate based on the reducing percentage of dumps between the different markets. If you want to go all the way down to 35, you're talking close to an 80% drop. Remember, the last one we had was 78%. So around that 75% mark or even the 70% mark, you're talking like high 39, low 40s, somewhere in there.
I don't think you're gonna get 80% drop. I think I'm more in line with using it. Now keep in mind, bearing in a recession, now we're talking maybe potentially something different. But the cost equals the electricity rate times the energy per Bitcoin. Okay, so it's that plus the hardware depreciation, which goes into Moore's law you were talking about, plus other overhead, which is cooling, maintenance, and pools fees and things like that. So that's what goes into the cost calculation. So there's that's basically what we're looking at. So interesting. I mean, so 71,000. I think you see a hard floor there. I don't know if that's really get that low to begin with, and not right now. I just don't know. No, that'll be interesting. Interesting to see if that'll come to fruition. Yeah. On another note, though, I was curious to let you guys know. I know there was straight up manipulation in the silver market since we last met on Monday. The thing that was crazy here, so silver was starting to really move aggressively, really moving. And it was very interesting because the CME servers decided to go down exactly when silver was making its massive move up, right? And then it reopened exactly right after the banks got a $24.4 billion liquidity from the Fed 10 hours later. Basically allowing the banks to cover their short positions with that money. So WTF? What? Like people that say that things aren't manipulated, you just got to look at take a look at the chain of events. There you go. I mean, this was basically it. So they halted it because they say they halted it. The CME servers that feed the actual in crypto we call it the Oracle, but the price from the CME was halted because they're saying the servers went down while silver was pumping, and then all of a sudden all this money was given to the banks that had short positions on silver. Okay, what? Like, come on, man, can't write this stuff. Anyhow, I'm bringing it up because it's just, you look at the event, you look at what goes on, and it's difficult to stomach. Like, we really are, things are very highly manipulated. Anything that's linked to TradFi, there's going to be manipulation. I don't care what anybody wants to say. And crypto, unfortunately, has been kind of moved into that category too, I think, with the spot ETFs. So
I think you're correct. The big question is just going to be to what degree. And what degree can you actually point to on the surface? Because the reality is, if you can point to some on the surface, odds are there's probably more beyond that you can't see. But there is there's an upper ceiling to it as well, which is like, how much can they do before it actually just goes into the realm of either just being blatantly illegal or just too ridiculous. So,
man, I don't think it's the spot ETFs. I think it's the centralized exchanges. I think that's the problem when it comes to crypto.
I think they're both valid options.
Yeah, they
Well, I
are,
mean,
but
a spot ETF is somebody buying and holding it and choosing when to buy it and sell it. Like they're like a spot holder, even if they're big, doesn't do to the chart what these big leverage players do to the chart, and the people that are spreading the leverage and offering the game. Those are the real culprits in my mind.
Right. Dace is fair. That is the RCA, or the root cause. That's definitely it, the central exchange, because they're the ones offering the leverage positions out there. And of course, you need spot ETFs to allow them to have that market. So once they had that, now they have the market central exchange. The central exchanges are the root of the problem. And then who's giving up most people in crypto? They're giving their money central exchanges that are basically rigging the system. So it's like they
You
are
kind
the
of
problem.
have to. It's the on
Yeah.
ramp and the off ramp.
Well, it's the off and on ramp. So if somebody can create and get the on and off ramp in place, bypassing central exchanges, now you're onto something. Which I know that's the theory with the RH system that he's trying to put in place in the Pulse chain. Obviously, is an on off ramp process in place that will bypass central exchanges. Now, would that be deemed highly illegal and around the entire world? Probably, yeah. But who knows? I just that is the issue. Everything is always centralized, and they're always going to push for its centralization. So yes, Dace, you're correct. Central exchanges are the root problem. People start
Yeah,
giving
look,
your money to central
spot
exchanges.
holders were never the problem, right? Exactly. Yeah, spot holders were never the problem, whether it's spot holders from a big name or a small name, right? It's the leverage action that gets really wild. And again, the leverage action from players who have a tremendous amount of supply, who stand to provide money for their shareholders and for themselves, and have their company perform if they use their assets in a way that moves the chart counter to the interests of 90% of the holders of the thing they're moving. That's the game we're in.
Yes.
It's the same thing with the money funds or the trading platforms that are out there. They make all their money off of commissions because of the trades. That's why they encourage trading so much, because the higher the frequency, the more they get to tax everybody on transactions. So
Correct.
it's
But
just
think
another
about, like, you're right. E-Trade makes that money off of doing that, but like at Binance, if you're running Binance and you're holding some giant percent of the stuff that they're trading, you're making a lot more money than E-Trade, who doesn't have proportionally nearly as much Pepsi or Coca-Cola or whatever else to play the game themselves, right? It's a concentrated version of that situation.
Yeah, but we covered this last couple of weeks, and we know Binance is these central exchanges. Binance, I'm looking at you big time. That they're making their ways in a lot of aspects. I mean, think about it. They're making money off of the leverage plays and liquidating people, which they have the most of the fun. So on that central exchange, they can push and move that price around if they so choose to do it. And then when those, like the flash crash we saw in, what was it, the 10th of November? Or what was it? Was it the 10th of November? They had the flash crash that kind of sparked this whole thing. They did that, and then October 10th, thanks. And then when they did that, so they're making money on commissions, they're making money on with their fees, they're making money on creating leverage, and then they're liquidating people's positions, but then they're also closing out their positions that are going to be higher in profit, but they're closing them early. And their quote was, "Oh, we didn't have the liquidity. We have to move it around to cover everything,
Correct.
cover other stuff." So yeah, so no matter what they do,
That's what
they're
I
going to
mean
make
by
a
it's a more
killing.
concentrated situation. Yeah,
You're
like,
right. You're
with
right.
E-Trade, they don't have the volume of the supply of what they're managing the trade of to be able to play the game that aggressively. But these centralized crypto exchanges, man, I mean, they're making out like bandits. Make no mistake.
They're making a fortune, man. Yeah, they are. They're making a fortune.
Tell you what, speaking of the banks and central exchanges making money, coming to us from Dace. Good sir, it appears that you are tracking something that many people don't want to talk about. According to the chart in the report, the Federal Reserve just pumped $13.5 billion into the U.S. banking system through overnight repos. Allegedly, second largest liquidity injection since COVID, and even surpasses the peak of the dot-com bubble. This is also right on the heels of today, marks the day that quantitative tightening at the Fed is over. And well, if that's the case, then they really did that with a bang, gotta say.
Yeah, look, and this also follows up with a few days ago, I think it's the bond market over the yen had another implosion that was even worse than the carry trade implosion from last go around. So yeah, things are moving very quickly now in terms of the liquidity issues around the big banks. I think they will, we can talk about how bad we think they're going to let it get before they turn the printer on, or have they learned their lesson from 21, right? And they've got these ways to support the big players and make sure it doesn't trickle down to the big guys. That's what everybody's afraid of. But like you said, the reality is QT is over as of today. And so, when the rate cuts come, especially in 6 months, when we get a new Fed chair in, I think the market will start to price in the time horizon of those things coming down the pipe now that we finally crossed the date on the calendar.
Makes sense. It's similar to a lot of the other stuff we talked about, like interest rates. Sure, we track the events because that's the date we can point to on the calendar, but when does it actually take effect on the market? When is it actually visible on the other charts? Well, it's hard to say, and I think it changes relatively each time, but there usually is a window that it falls in. So I would expect money supply, banking system, repos, that kind of stuff is going to have a similar effect. Whether it's either, like you mentioned previously, they had an emergency injection from the Federal Reserve to cover the issues going on with the exchanges and the halting trades when silver was pumping, or it's just them doing this in response to the Asian markets, which, by the way, that is also a narrative that people are pointing to for the most recent crash that happened on Sunday night. By crash, I mean correction of like $5,000 in Bitcoin price. Overall, nothing that crazy, but at the same time, it's a complex world. People are going to be pointing to a lot of different things. Doesn't mean that everyone's wrong. Could mean that everyone is also correct, which would be the worst because it means that no one actually knows the correct answer, but they all have bits and pieces of the truth. And I mean, a lot of people gotten wrecked with just having partial information. So I hope that none of us here do that, and none of you guys watching at home do that either. You are all very informed people, I would like to believe, considering you've been hanging out with us, watching us on a weekly basis, and getting inside the Telegram as well, which you guys have been carrying some great conversation lately as well, making all of us over here on the team think about stuff as well. But yeah, interesting stuff. By the way, I do have one final thing I did want to show before we get out of here. Coming to us from Max Crypto, we have Japan QE, dump. Japan yield rising, dump. Coinbase premium positive, dump. Coinbase premium negative, also dump. Gold pump, dump. Gold dump, also dump. No rate cuts, dump. Rate cuts, dump. Good macro, dump. Bad macro, dump. QT start, dump. QT end, dump. And of course, they made a meme out of our favorite Wall Street cheat sheet, the psychology of a market cycle. And we surpassed capitulation, anger. We went to depression, deeper depression, wrecked, rector, ultimate rector, annihilation, Cretaceous, Paleogene, extinction level event. So I bring
That's
this up
great.
because
That's great.
this is the sentiment. This is the sentiment right now. I'm just saying.
Yeah, and that's a good way to look at it. And like we've said, we want to try to be more on the contrarian side. So if everybody is saying that we're dumping, we're going lower, and yet here we are with the guys that the market makers are buying. It's like like we talked about it. There's if could they be also working with central exchanges to dump it so like Vanguard can get in and other people can start now getting in, control them? Who knows, man? But ultimately, they're buying and they're not looking to sell anytime soon. They want to build the percentage of what they can control for many reasons. You'll say national security and all these other fancy things that they'll throw out there. But bottom line is they're looking to accumulate. So if you're long term, you want to be owning and holding for long periods of time. I know that's easy. It's tough to say when you're being pummeled, but you got to look at we always said this, you have to have a different portfolio. If you're very active and you're looking to make more profits, and you have to be more correlated, making higher trades, meaning within weeks to months to make those times, that's much more difficult. If your time horizon is 5 years, 10 years, 15, 20, whatever that is, then just accumulate, hold, and then when times get to a certain point, you want to raise that dollar cost average up or raise more powder to push a dollar cost average lower prices, and you want to start accumulating. That's what you want to do. So right now things are getting beaten down pretty good. Can they go lower? They can. I still expect there to be some type of a relief rally that's going to retest. Typically that's how markets work. They don't go straight down. They typically have a relief rally at some point. And then that's when the time when you have to make your decision. Now, what I would advise everybody to do, probably, because everybody probably needs to take this approach regardless of what you're doing, Make your decision now. Don't wait till the time happens and then you're starting to figure it out on the fly. Do not do that. Have a decision on what you want to do, and then have your levels or where you want to exit, and then take action. Don't sit and write it down. Don't sit there and try to figure this out. Now is the time to start planning what you want to do. Do you want to stay long in these positions? Are you looking to unwind some positions, take some risk off? You know, you got to come peace with that now.
Agreed. Have a plan, execute on the plan. I mean, you said that now is the time for planning. I would argue maybe like last year or the year before that was the time for planning. But at the same time, you got to revise it as you get real-time data. Not change the entire thing and throw it out the window, but revise it as you get good data that is within the what you believe was possible and will not invalidate the plan entirely. So, I mean, as it stands right now, Bitcoin did have a top in October. Gosh, what was that? The 6th of October at $126,000. Pretty much in line with past 4-year cycle timelines. We have dropped below the 50-week moving average. Those are 2 data points that you can really point to say that the trend is holding. However, at the same time, I think there's a lot of other data points that also argue the exact opposite. None of the indicators hit. There's the quantitative easing has not come yet. There's all this. I mean, speculation is probably even a weak word for at this point. It's almost guaranteed because we have interest rates now. Quantitative tightening ended today, and as it stands right now, it's going to start ramping up. Not explicitly, but in order to keep the balance sheet at a workable level for the Federal Reserve, it will start increasing just due to normal activity. And then on top of that, more money coming in. Didn't see the levels getting hit that people were expecting to based on previous targets. So that also could theoretically invalidate past performance as well. So just saying, it's complicated, but that's why it pays to have the plan and then also understand the balance of risks and probabilities when it comes to executing on the different plans.
I still think we're going to be in this period where we're getting max pain to the downside. This could last until December, could last until January, who knows? But then the other max pain is when things start to pump and ramp up. Are you going to catch people who are waiting for prices to go lower? If we start going sideways, is that going to, irritate people who are trying to have shorts on, who are trying to look for lower prices to maybe get back in at lower prices? I just think you're going to have a lot of manipulation going on, and I think prices are it's going to fluster the bears and the bulls. So be prepared for this. It's not going to get any easier. TradFi comes in here, they're going to muddle up the waters a lot. It's not going to be whatever was in the past. I just don't think it's going to be. I think you're going to have some pain here, but we could also have a rally that goes into January and into 2026, where now the people that are on the bear side are feeling the pain, or they're trying to have to FOMO back in, and then you have a blow off top. I mean, there's a lot of things that could still play out here.
Yeah, and nothing's guaranteed either way, so always keep that in mind. But outside of that, please remember, nothing we say here is financial advice. We're just trying to build a community of like-minded folks who are interested in the same things. We can't tell you what to do. That's only up to you to decide for yourself. However, we can all work together. We can all win together, which, by the way, if you would like to work with us, and we would love to have you on board the team, head on over to walktheblockndf.com, where you can find the membership page. Inside of there, you'll find a link to sign up and get into our private Telegram. Inside of there is where you're going to find all the latest and greatest information, whether it's news stories or the conversations that we have. That is where it's all going to be. So we like to say that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. When we all work together, we can all win together. We would love to have you guys, and we hope that more of you guys make the jump. But if you don't, we will be here every Monday, 8 p.m. Eastern time, covering everything of the day, talking about the old Black Friday news stories because they're the fun, cheesy thing, but also it leads into the more hardcore economic stuff. And then ultimately, it leads back to the crypto stuff, which is what we're interested in. So that is what we got for our show tonight. Gentlemen, do we have any final thoughts before we get out of here? Dace, the floor is yours, sir.
No, I don't think so. Great show. I think we covered a lot of the angles. Like Tracker, what you said, I think things are not like they were. Like you said, it's not going to be it's already not be the same. If you look at PMI charts we looked at, if you look at the Bitcoin cycle movements, the more things change, the more they stay the same. I think that's something that's said. But yeah, look, I think people that try to time out the cycle, just say, hey, look, it's a 4-year cycle. I think that some of those people have played some amount of momentum, but I think when you look at how the government treats its debt, and the timing of that, we have a lot of interesting things to look forward to in 26, and so probably would pay to come join and stay in touch with us, and because we're going to be here every week following it all.
Well said, sir. Tracker, what you got?
Nothing. Just really at this point, just keep following. We're covering a lot of stuff. You guys see us talk about what we talk in the show. We're always piggybacking and researching a lot of stuff throughout the weeks, trying to keep our ears on the ground of what's going on, what's the settlement out there, what everybody's looking at, what are the moving pieces. So we're always trying to keep up with it all. Bottom line is, I don't expect a lot of stuff to happen in December. I think people are going to be waiting to make moves probably in January if they're going to be making the moves. But who's to say I'm right? Because things could happen. I guess ultimately what I'm trying to lean to is, don't get flustered, don't get frustrated. Just have your plan laid out, and then when time comes, execute on your time. Personally, I'm holding my positions. I'm not looking to unwind anything. I think a lot of people are in that camp where if we do get a rally, people will probably start to sell. I think those are more the retail sectors that have been selling. And I know some of the central exchanges have been selling, obviously, but the big guys on the block, the big TradFi folks, have been purchasing and buying. So it's a big, it's an exchanging of assets currently right now that you're seeing come unfold. I think we're going to stay sideways in this. Don't get too flustered and just kind of enjoy the holidays, enjoy the time, just kind of take it easy and just follow what's going on. But there's going to be some actions moving, and we'll be here to try to track all those things that are going on, because there are some things that are constantly going on, that are happening that are not getting really discussed a lot about. You got to kind of see what's happening. You can start piecing the pieces together. Once you have all those things aligned, like we kind of lay out in the show, that you start to understand why we're in the sentiment that we have. So just stick with us.
Love it. Excellent thoughts. I think that there's a lot of different people making different moves in the markets. I've been covering some stuff about Bitcoin whales. It appears that they previously had been dumping, but new reports indicate that they're actually picking back up again. And then outside of that, TradFi is going to continue to TradFi. By the way, Tracker, I'm seeing a nice little band of possible liquidation right at the $94,000, $95,000 level. So if Max Payne theory is correct again, there's a decent chance that we could see it move up that way to go, try to liquidate a few more folks. But again, only time will tell. Outside of that, ladies and gentlemen, thank you so much for joining us tonight. We appreciate you guys spending time here with us every week. Just a heads up, the Federal Reserve meeting is coming up on the 10th and 11th, so we're not going to be talking about that next week too much, hopefully, but we should have the results the following week, where we'll see if we do get our rate cut. And by the way, I believe that the percentage is sitting currently at 87% for a quarter point rate cut. So only time will tell on that one as well. And see how mad Jerome Powell gets at people for trying to predict the markets as usual, because it's always a good laugh. Either way, ladies and gentlemen, thank you so much for joining us. We will catch you guys next week, or we'll catch you guys inside of the Telegram, fielding all of your excellent questions and catching you for some live streams coming up shortly. With that being said, we thank you again very much for your time, and good evening. Good night, everybody.